Good day and welcome to this market update presentation by ETM Analytics, brought to you by George Glenos and presented by myself, Richard Salia from Treasury One. George, I want to hand over to you quickly. The market's been in turmoil. The rand is strengthened. I've looked at the currency. It's only like gold, silver, and a few other currencies that's done better than the rand for the year. But we're top of the pops, as we call it. But all the focus will probably is on what's happening in the US. Hard, soft landing, medium landing. What landing? Is the Fed going to cut tonight 25 or are they going to cut 50? Is it 200 basis points in the next year? Is it 125? Is it 300? So why don't you just give us a little bit of insight of what's happening in the markets, George?
Thank you, Vichard, and welcome to everybody. Hope this gives you a nice update as we prepare for the central bank decisions. We've got the Fed this evening. We've got the Bank of England tomorrow. We've, of course, got the South African Reserve Bank tomorrow as well. And there's a lot of speculation that's going on in the market at the moment, with a lot of people questioning whether the Fed has perhaps waited a little bit too long. Are they risking policy error? Should they be moving 50 basis points? There have been one or two Fed members that have come out and said as much. So let me take you through some of the slides that we're looking at, and we can then make up our own minds as to how we think this all plays out. Obviously, whatever happens in the US is going to have direct impact to how the Reserve Bank responds and what it chooses to do with its monetary policy. At this stage, it looks like they're going to be more conservative, but let's go through it and we can come to that conclusion together. So the first chart that I always like to begin with is of course, our dollar liquidity cycle, because we think that it's one of the best business cycle indicators that we've got, and gives us a very firm perspective as to whereabouts in the business cycle we are. Are we on the way up? Are we on the way down? If we're on the way down, how close are we to the bottom? It looks like we're probably 3/4 of the way down with a little ways to go. Obviously, you can also see from this chart that the troughs are becoming higher every cycle, and we don't think that this cycle is going to be any different. So we think that we're approaching we're approaching the bottom or near the bottom as we speak. This data is obviously as of July this year, so it's a little bit out of date. We think that red line goes one or two notches lower before we do hit that bottom. If you had to press me for a timeline, I'd say that bottom probably comes in towards the back end of this year, beginning of next year. So we don't have long to go now. That business cycle is really mature. The central banks are withdrawing liquidity quite a bit. The lagged effects of all the interest rate hikes that we've seen over the years are now starting to take real effect and causing some stress and pain within the banking system and elsewhere. The credit cycle is slowing, and of course that has consequences. So the Fed is going to be operating against this backdrop. The other backdrop that the Fed is going to be operating against is this geopolitical environment, which is fraught with volatility. So we've seen the war in Ukraine. That was the first spike that you see on the left-hand part of this chart. Then we had the war breaking out between Israel and Hamas in Gaza, and that's the second spike that you see. And more recently, you'll see that there were signs that this was going to spike yet again as Israel started ramping up tensions with the likes of Iran by attacking Hezbollah in Lebanon. So we've got an environment right now which is a little bit fraught with uncertainty, and it can go either way. Again, something that the authorities need to take into consideration, although it's difficult at this stage to determine exactly what the implications of all of this will be. Nonetheless, we do know that when you get a big spike in geopolitical risk, what we tend to find is that there's a rotation to safety, which would naturally favor the dollar, favor the gold price. So it's somewhat encouraging to see that the geopolitical risk come back down again, because it does ease the pressure a little bit on those authorities and the decision-making process. Of course, it would be remiss of me not to mention the political volatility that's happening in the US as well, because that also forms part of the broader equation of what the Fed has to take into consideration. And that's, of course, the way things have flipped around from there where Donald Trump was battling against Joe Biden to now Donald Trump battling Kamala Harris. And of course, the Democrat marketing machinery has shifted very firmly behind Harris and boosted her quite significantly compared to what was the case with Biden. Right now, she seems to be in the lead, the candidate most likely to become the next president. But we think that it's probably going to settle closer to a 50-50 as we draw closer to that November 5 environment. However, we do know what Harris stands for. She's been in power with Biden for the past 4 years. So therefore, what we think we're going to get out of her is pretty much more of the same. That includes deficit spending. It includes social welfare. It includes growing government. It includes a more socialist bend to the policies. That would be what would likely be a little different under Trump, although his impact isn't entirely clear either. Through his first tenure, he got stuck with COVID and all the distortions that came from not just what was happening globally, but of course the way that the Federal Reserve responded to everything that was going on. So you can't really take his first tenure as much of a barometer for how things are going to work out. In fact, if you looked at the stock market, it's entirely unclear whether Trump was good or bad for stocks, because on one hand, he might be pro-market. On the other hand, he wants to impose a lot of tariffs, which would be, in a sense, inflationary and detract from GDP growth. So it's a little bit up in the air. I don't know that the Federal Reserve would be particularly happy to call the implications of a win one way or another, and the consequences that would have on broader policy. But it obviously is something that we have to take into consideration too. And it's a factor that might keep the authorities a little more cautious, given that there could be some fairly hefty gyrations one way or another. And whilst at the same time, you do risk policy error by waiting too long, moving too quickly could also be problematic. And in fact, we had the Bank for International Settlements warning central banks not to move too aggressively too soon. Part of the problem when it comes to America is that we have a vast array of data, and some of it is leading to some confusing signals. So if you have a look at many of the leading indicators within the US, you'll find that they are pointing to recession. Every time we've had the collection of leading indicators dropping, as it's dropped in this chart on the orange line, to the levels that we've seen, it has tended to portend a recession. It's happened pretty much every time, going all the way back to the 1960s. So, why would this time be any different? Well, the question is, whether or not the real economy is going to catch up to these leading indicators. And the thing is that it isn't. So if you have a look at real GDP, which is the blue line, you can see that it's not often you get this huge deviation between the blue line and the orange line. It sometimes happens through those troughs, but in this particular case, it barely touched zero. It didn't even go close, actually, never mind go negative. So there are a number of indicators that are pointing to a slowdown, and it may be that the slowdown has been delayed by the fact that there's been a lot of intervention and lagged effects of that intervention dating back to the pandemic days. But some of that comes to an end towards the back end of this year. So we think that there's more to the story than just what we're seeing at the moment. There is a danger that the US could experience a heftier downturn than what we have seen so far. So let's go through some of those factors that have supported GDP. And on the left-hand side, it's been excess savings. This was when the federal government, through the course of the pandemic, literally wrote out checks to households to help them stay afloat, not renege on any of their debt, and to keep the broader banking structure alive without too much stress, so that America could recover post-lockdown. A lot of that, they pushed a good $2.25 trillion towards households. That's a colossal amount. That was funded primarily by the Federal Reserve, that printed up $5 trillion and bought a lot of debt from the government, which then used it to pass it on to households. But as you can see, that number has shifted from $2.25 trillion all the way down to under $500 billion currently, and looking to trend a lot lower through the course of the next few months. The point to make is that the effects of this excess saving is going to dwindle as the year unfolds and as we progress to the end of the year. The other point to make is that that the deficit spending that we've had in recent years at some point is going to need to be tackled. Now, if you believe Trump and if you believe the Democrats at this point in time, shrinking this budget deficit is a priority for both. So let's see. The Congressional Budget Office doesn't believe them. Their forecast shows that, if anything, their deficit spending is going to get worse. However, let's see how that unfolds. It's something that we are going to need to, again, keep track of. But quite clearly, the central bank is starting to put pressure on the fiscal authorities to rein in some of that deficit spending. The way they're doing that is through what we call quantitative tightening. It's the exact opposite of quantitative easing. So if quantitative easing is the effect of pumping money and liquidity into the global economy, this is the effective withdrawal of that liquidity back out of the market. And the way that they do that is by selling the very bonds that they bought from those governments in the first place. So they increase the supply of bonds into the market. It raises those interest rates. Those interest rates become more punitive. It slows down the economy. It becomes a little bit of a vicious circle, but it is a moral hazard that the central banks want to avoid. They want to avoid always being called on by the governments to help bail them out whenever things become a little tougher. So this is the interplay that's taking place between the central bank and the fiscal authorities, which is why this meeting this evening is so important, because not only are we going to learn about what they're going to do on interest rates, which will certainly help households if they reduce them, but also what they're going to do on the basis of their balance sheet. Are they going to continue with their quantitative tightening, or are they going to end that too? I suspect they're going to continue with the quantitative tightening because they're going to want to continue putting some pressure on governments to reform, whilst at the same time easing some of that pressure on households. The point is that these are factors that are likely to help bring inflation back under control. But whilst we enter the end of the business cycle, the one thing is clear, is that policy uncertainty is going to rise. It always tends to happen towards the end of a business cycle, and we don't think that this time is going to be any different. So that blue line, as you see, signaling policy uncertainty, is starting to turn less negative. In other words, it's becoming less certain. At the point where it crosses above zero, it starts to become more uncertain. And as that blue line starts to rise, so it places some pressure on stock markets. Stock markets don't like uncertainty, and so the more that uncertainty rises, the more vulnerable stock markets are likely to become. That's an important point to just take note of, because if uncertainty rises and stock markets start to come under pressure, you'll tend to find that there's a rotation back towards, for example, the dollar as a safe haven asset. Well, we've got to take that into consideration, because there are some warning signs on the horizon that we've got to take on board. One of them being the US recession probability data produced by the Fed itself. As you can see, as of the August figures, the probability of recession in the US was up to 40%. It doesn't get all that much worse than this. Well, it does in some dramatic instances like the global financial crisis. But typically, when you get to these sorts of levels, it signals the possibility of a recession. And naturally, that is something we've got to be careful, partly because stock market indicators, as you see from this chart, are extremely overvalued. No matter which one of these respected indicators that you look at, they're all trading well above their long-term means, which are those horizontal blue, orange, and black lines that you see on this chart. The further they deviate away from those long-term means, the greater the degree of overvaluation. And as you can see right now, we are almost at record-wide levels of overvaluation, which means that there is, of course, some concern that there's a correction that could follow, and that correction will have implications for the dollar and for the way monetary policy unfolds. The August flash crash gave us a little sense of some of that volatility and what that might look like. We did get a taste of what might happen if stock markets correct. The Rand did catch a bit of a fright along with many other emerging markets. That's when the VIX spiked very, very sharply and stock markets started to show signs of collapse. That quickly reversed when the Fed came out and said, no, they are going to look at reducing interest rates. What we've got at the moment is actually speculation that they're not only going to reduce interest rates by 25, but could go as much as 50 basis points. In trying to assess which is the more correct decision, we've got to take into consideration the broader business cycle. We saw the very first chart, that dollar liquidity cycle, that gave us a taste of things slowing down. The other indicators that we often draw on to give us that perspective is the shape of the yield curve. Typically, when they disinvert, in other words, when both of these lines go back above zero, that tends to be the danger signal. That's typically when central banks are starting to cut interest rates quite aggressively, knowing that the only time that they would really do that is when they're faced with recessionary type of conditions. That effectively means that we're on the cusp of that recessionary kind of environment. And the labor market data is bearing that out as well. We are starting to see signs that the labor market is loosening. The left-hand chart is simply the unemployment rate versus the 3-year moving average. Typically, every time those two have crossed, it tended to signal recession. What we did on the right-hand chart is simply divide the one by the other. So the minute you go below the ratio of one, that tends to signal difficulties. They're essentially the exact same chart, just reflected differently. You will notice on the right-hand side, every time that blue line has gone below one, recession has been kicked, and so that's something to obviously take on board. Also important to take on board is the fact that US labor market data has been heavily revised historically, one of the biggest revisions since the global financial crisis, and that was the biggest revision ever. So we're talking about a massive revision in the data that the Fed utilized over many, many months to justify why interest rates needed to be as high as they were. Now it turns out that actually the Fed could have run with interest rates lower than what they were. And so that is now starting to catch up to them, which is why, again, there is the speculation that there could be as much as a 50 basis point cut this evening. Inflation is on the way down. There's no question about that. We're seeing that across the board, whether you look at South Africa, that's had a sticky inflation rate, or you look at global inflation, high middle income inflation, all of them are trending lower. And in the case of the US in particular, which pertains to the meeting this evening, the tightness of money supply, which you see in the blue line, which is still negative, money supply growth in M2 is still negative. We believe that that's gravitationally going to pull inflation lower, and that the Fed is indeed on track to meet its target of 2%. That's a good thing. I don't think that is something that we need to be concerned about at all. It looks like the momentum is still there and behind inflation. So we think that that is going to happen, which is why when you have a look at the futures markets, they are pricing in rate cuts. And if I'd showed you this picture 6 months ago, you would have noticed that that orange line, which indicates the Fed, would have been dropping at a far more gradual pace than that of the BOE and the ECB. Shift forward to today, and that's just changed dramatically. So, we're talking about a good 250 basis points worth of rate cuts due by the Fed between now pretty much and the end of 2025, with the risk of perhaps one more in 2026. As things stand, we think that that is pretty realistic. If anything, we think that they could go a little bit more. What we tend to find, or what we have found historically, is that investors tend to underestimate the amplitude of the rate cycles. We think that this could very well happen again, and that the Fed could cut rates a little more aggressively. And so there are implications for that going forward. One of them is that the US dollar loses some of its attraction. And we can see some early signs of that, in that the Japanese yen has surged very strongly against the dollar over the past couple of months. And we can see that the speculative element has shifted from being net short and aggressively net short the Japanese yen to now being firmly net long. And that's that blue line that has jumped very, very sharply versus the dollar yen, which has fallen very sharply. In both cases, what that tells us is that the Japanese carry trade into the US dollar has snapped. And so as it snaps, one does have to raise questions about the dollar's overvaluation and whether or not it has the ability to sustain current levels. We think that it doesn't, and that there are enough reasons for that we are seeing at the moment for the dollar to correct. if we go over some of those reasons, what are we talking about? Well, we're talking about a US economy that is slowing down. We're talking about a Federal Reserve that's likely to cut rates more aggressively than other central banks in order to engineer what they call a soft landing. Now, a soft landing, together with vastly lower interest rates, is probably the worst case scenario you could picture for the dollar, for the simple reason that you are reducing the dollar's attraction by reducing its interest rates on the one hand. On the other hand, you're not creating an environment of massive risk aversion where everybody runs for the safety of the dollar. So if the Fed gets it right to engineer a soft landing, which doesn't see people scurrying to safe havens, and if you get the Fed achieving that through reducing interest rates quite aggressively, we think that's a recipe for a weaker dollar, and that obviously has longer-term implications for the likes of the South African rand. Looking at a different indicator altogether as we search for corroborating evidence, what we did is we focused on the gold price versus the trade-weighted dollar. And what we found is that there's been a big disconnect that's taken place between the performance of the gold price and the performance of the dollar. Typically, these two tend to move together. Now, up until the Fed started with quantitative easing, that happened during the global financial crisis of 2009, you tended to find that it was the dollar that led the gold price. Post that, it's the gold price that has led the dollar, which is why we believe that this is now a powerful indicator, which tells us that, if anything, it's the dollar that needs to lose ground. That blue line, by the way, is inverted. I inverted it so that you could see that there is a relationship between the two. And what the general direction is that blue line should go to. In other words, if it's inverted and that blue arrow is pointing up, it means if you looked at the left-hand axis, the trade-weighted dollar would be losing ground. You'll see that the numbers become progressively more negative the higher up the axis we go. This time, we also can't rely on China to bail the world out and to make it a rosier place, because China is battling its own demons. Its real estate market, for example, that bubble has well and truly burst. It has popped. Residential real estate has gone from, or not just residential, but real estate more generally as a percent of GDP has shifted from some 20% down to 7.5%. So it's more than halved. The time it takes to sell property on the market, which is the right-hand chart, has risen to numerous months, rather, almost 4 years, 3.5 odd years, which is staggering. If one has a look at the World Economic Outlook IMF forecast for China, they're talking about growth rates subsiding. And of course, if I correlate one of my favorite indicators, which is M2 money supply growth with Chinese inflation, it's telling us that China is going to be dealing with deflation going forward over the next year to 18 months. And the importance and significance of that is that China remains the world's biggest producer. It exports tremendously, and it will export that deflation to the rest of the world. So we've got deflation coming from China. We've got a US economy that's slowing down. We've got global inflationary pressures that are dropping quite sharply. All in all, we've got an environment where the Fed is going to feel fairly justified in cutting rates, and cutting rates quite aggressively. So that frames the international backdrop quite nicely. As we shift to the local now market to try and understand what the Reserve Bank might do, well, let's just consider our overall macroeconomic conditions indicator. This isn't GDP. We believe that this is better than GDP. So it takes a number of real economy indicators into consideration, and we split it up into a short-term and a long-term indicator to give you a sense of what it's saying. You'll notice on the left-hand side that we've labeled the different regions for whether it's an easier or a more difficult time to do business. And quite clearly on the short term, we're in challenging conditions. On the long term, we're highly adverse. The one talks to the structural problems the South African economy faces. The other talks to the more cyclical stuff that we kind of, I guess, get used to on a day-to-day and month-by-month basis. The upside to this chart is that in both cases, we're seeing some green shoots. So we're seeing some signs that the introduction of the government of national unity, the reforms that they're talking about, the stopping of load shedding, plus leveraging more of the private sector to assist in SOEs and defunct municipalities, rail, ports, and the rest is having a meaningful positive effect, as is the stronger rand and the declining inflation. So all in all, we think that the picture is looking a little rosier. And we think, but at the same time, it's challenging enough to prompt the central bank to look at reducing interest rates. And all of that's important because we utilize that information to give us a sense of how the central bank will behave. But over and above that, once we understand how the central bank will behave, we also want to know how the bond market will respond. And the reason why we want to know how the bond market will respond is because it's one of the biggest drivers of the rand. So portfolio flows from foreigners into and out of South Africa's bond market make a massive difference. So first, let's just have a look at this chart and have a gander at the blue line, which is the emerging markets bond exchange traded fund. It has been doing really well. So emerging markets bonds generally have been doing really, really well. If one compares that to the S&P 500, the volatility, the VIX, we'll see that the two have got a nice inverse relationship. Again, it speaks to the need for the Fed to try and engineer soft landing, which will keep the VIX suppressed. It means that emerging markets are likely to continue attracting some portfolio flows into their bond markets. And so just by way of proof to show you what I'm referring to, you have a look at the red line, which is the dollar rand, versus your black line, which is the inflows into and out of the South Africa's bond market, and you begin to realize that the more flows into South Africa's bond market, in other words, the more that black line goes up, and that's reflected on the left-hand axis, the stronger the probability that, or the higher the probability that the rand will be appreciating, which is reflected by the red line going upwards. In this case, again, we flipped the red line on its head. It's inverted, or you would see that be going back down again, which effectively denotes some rand strength. The question that then arises is whether or not reducing interest rates is going to eat away at South Africa's carry. And if one has a look at a longer-term chart like this one, which effectively covers almost the past 10 years, 8 years in total, you'll see that that blue line has sunk So we still think that there's a healthy spread between South African and US bond yields, especially now given the government of national unity and the talk of all the reforms that they are looking to implement. Furthermore, if I have a look at what the futures markets has priced in, we've got the Fed versus the South African Reserve Bank reflected in the top half of this chart. That blue line being below the black line means that the Federal Reserve is likely to cut interest rates a lot more than the Reserve Bank. The bottom half of this chart simply reflects the difference between those two lines. In other words, it tells us that the Federal Reserve is likely to cut interest rates by the very latest measure 100 basis points more than the South African Reserve Bank. Now, why that's important is because it helps to reestablish that spread. So if on the previous chart, as you see, that spread has narrowed to under 600 basis points, what we're saying is that that spread is going to, at the base minimum, probably remain flat around that level, or potentially even rise again to help boost South Africa's carry attractiveness, which when we look at it on our carry attractiveness index, is not too bad. We kind of like middle tabling at the moment. But given the fact that the South African Reserve Bank is looking to be more conservative than many other central banks around there, we think that that red bar on the left-hand chart is going to gradually migrate back up, and that South Africa's carry attractiveness, as reflected in the time series chart on the right-hand side, that green line could very well score more out of 10. Currently hovering just under 6 out of 10. We think that it could creep back up to around about the 7 out of 10 through the course of the next 6 months. And if it does so, again, Rand enjoys some fairly good support. And the Rand has enjoyed some support since the government of national unity came into power. The transition was so smooth. It went so quickly in a way that most European countries that work with coalitions haven't been able to achieve. It was nothing short of a miracle in some respects, but because it was a smooth and there were no political fights that broke out challenging the election results, etc., the Rand expressed some tremendous relief, and you've seen that in that black line, which has steadily gone up and up and up to the point where we are now, for the year to date, the best performing currency according to this EM basket of countries that we compare ourselves to. That is something fairly significant. Last year, the Rand wasn't performing as well because there were a lot of concerns. This year, you can see that some of those concerns have lifted and people are looking far more optimistically at the outlook for South Africa. They're looking for some fiscal reforms to be implemented. They are looking for the private sector to be included in state-owned enterprise reforms. They're looking for that government of national unity to hold the different parties within it, to hold each other to account and to raise the overall level of effectiveness and efficiency. There is talk that South Africa is going to be removed off the grey list and come the mid-2025, which would be great news. And then last but not least, the dollar's overvaluation, which we've already spoken about. And even when we look at our presidential policy scorecard and you focus specifically on the black line, which is the more important of the two in this context, it's constructive and positive to see that line moving upwards. It means that, generally speaking, this new government is now on a firmer footing to do better work. And so we have high hopes that that black line moves back towards the 50, which would denote a far more stable environment in which growth would be more easily come by. When we have a look at our bigger structural indicators, some good news to take out of this as well. We break the economy down into three main buckets. The monetary bucket, which typically focuses on the behavior and performance of the South African Reserve Bank. We look at the fiscal bucket, which is obviously the performance of National Treasury and the Department of Finance and how they've managed the economy. And then we look at the fundamentals, which is essentially the private sector and how it responds to the other two. What we are noticing is that in both of those, there's been a strong uptick recently, which should be welcomed. It means that there is a little bit of progress taking place in reducing fiscal risk, and it does mean that the private sector is looking a lot more optimistically at the future than what we've seen up until now. So, excuse me, it has helped overall resilience rise. And that's great news because we're just about to get the Reserve Bank cutting interest rates, which will bring that green line back down. But it is encouraging that overall resilience of the South African economy is improving. And so it shouldn't surprise you that the Rand has strengthened and that it is heading back towards fair value, which we think hovers around about the 1730 rate as we speak. And because of all the factors that I've spoken about, we're not writing off the possibility that the Rand goes into overvalued territory. So we think that it potentially goes to that 1730 and may even surpass that level. The obvious value for exporters is dwindling pretty quickly, but finally, importers might very well start to gain a little bit of an improved environment in which they can bring in their goods to sell into the open market. When we're looking at the shorter term currency valuations, just to get a sense of where the Rand is at, well, the previous chart showed that we were approaching fair value. Even if I have a look at the Rand real effective exchange rate on the left-hand side, it's telling us we're close to fair value too. But if you break down and you go into more of the detail, some interesting pictures emerge. So it tells us that Rand is still undervalued to the dollar by approximately 8%. Against the euro on the left-hand side, similarly 8% undervalued against the British pound. We're sitting at about 6.5–7% undervalued. But it's against the yen that we've been very, very heavily overvalued and at some point looked like we were going to be some 30% overvalued. We didn't quite get there. It's reversed back down, and we're now hovering just over 11% overvalued. That's that whole carry trade unwinding. We need to be careful of that because that can generate some big gyrations in currency markets. But we think that at this stage of the game, the South African rand is well placed to weather the storm. One of the reasons being, if you have a look at the chart on the right, our terms of trade have improved to some of the highest levels since May of 2022. So that's a fairly significant development and very firmly helps propel South Africa's trade account into surplus and limit the damage on our current account. If we have a look also at our Rand sentiment indicator, which has turned useful again, it is telling us that Rand sentiment has moved back positive and that it too is signaling a period of sustained Rand appreciation. You can see quite clearly the minute we got past the elections risk, which was that dip down, we have moved back the other way. Again, a vote of confidence in the government of national unity and how that's looking to proceed. So we think that the Reserve Bank is in a position to cut rates and cut rates aggressively. The market is positioned for 150 basis points worth of cuts between now and the end of next year. We think that it could even be a little bit more than that. It wouldn't surprise me if we were talking about almost 200 basis points worth of cuts. And that's because we typically find that both the market and the Reserve Bank underestimate the amplitudes of these cycles. Sometimes they always tend to be a little bit more pronounced than what it turns out to be. The models, by their very nature, tend to be more conservative, and as a result, we can sometimes miss the full amplitude of these moves. So we think that's where the risk lies. And you can see very clearly from this chart, if you have a look at that arrow, which signals where we think the repo rate is going to go to and at what trajectory. If that's all there was in this rate cut cycle, it would actually be one of the shallowest rate cut cycles in SA's history. So we think there's a possibility of perhaps a little bit more than that. But reduction in interest rates tomorrow, almost a certainty in South Africa. The question is whether it's going to be 25 or 50. Strong arguments for both, although knowing the SARB and their conservatism, it will probably only be 25. They'll keep their powder dry for a little bit longer just to make sure that the rand doesn't catch some sort of a wobble post this FOMC, the Fed's meeting this evening. And then they will, may feel a little more comfortable doing a little bit more. The bottom line in all of this is that we're approaching a cyclical downturn. We think that economically speaking, things are going to tighten up a little bit over the next 6 months. However, the positive of all of that is that this is the trigger that brings interest rates, inflation and interest rates back down. And that's what essentially starts the new upcycle, which we think is going to unfold through 2025. So we think we're well placed for a much better 2025 than 2024 or 2023. And so we shouldn't be too negative about the fact that we might go into short-term recessionary conditions in the next few months. We think we should be focusing on the cycle that follows, which is likely to include a dollar that comes under significant pressure, a global interest rate environment that comes down quite substantially, a rand that improves fairly significantly, lower inflation, and generally speaking, a far more upbeat outlook and assessment for the economy internationally as well as domestically. And on that note, Wichard, I'm going to pause and hand it back to you for distribution, I guess, to your clients.
Yeah, thanks, George. Not surprising at all the news that's been what we've been saying all along. It's playing out at the moment. The terms of trade that you're talking about, obviously that's mostly supported by the gold prices that's up here and the oil prices that's quite low. Because of the lack of demand on the world market. Because if you look at other metals like copper, aluminium, platinum, palladium, all those metals are actually down. So is that what's holding up our terms of trade at this stage?
Yeah, so you're right to point that out because you've got a difference between the industrial metals that are utilized to produce stuff and the other metals that are, like gold, that are seen more as a safe haven type of commodity. And the one set is obviously being affected by the weak demand. The other is enjoying the fact that there's been some uncertainty, that people are looking for safe haven. They are anticipating a weaker dollar. And at the same time, there has been a general push by some of the major central banks internationally to build their holdings of gold. The combination of that has been positive for South Africa. So yes, you're quite right. The weaker demand is affecting some of those industrial metals as well as the oil price, because demand is weakening. On the flip side, we've got some really good news coming through on the gold price, which is rising to fresh record levels and boosting South Africa's terms of trade. So again, it tends to lend some support to the rand and underpin the appreciative trend that we've seen so far.
And then lastly, just to end off, George, just to go back to the rand. You said rand's fair value is around 1750, and we approach it. Do you think we've been trading in the 18-19 band for most of the last before this last 15 months, and then we sort of shifted our range lower to a 1750, 1850 type of range? Do you think it's time to look to shift that range maybe lower again to a 17, 18 type of range for the next year or 12 months? Next 12 months?
Yeah, I would say that there's value in shifting that range a little lower. I don't know that it's going to be sustained for particularly long, but certainly, could I see it being sustained for a year? Sure. We've seen rand cycles in the past where once it gets into this appreciative mood, it can go a lot further than people anticipate and can stay stronger for longer. A lot of it's going to depend on how conservative the central bank is. If that central bank remains conservative, as it has been in recent years, and we haven't even touched on the possibility that Kganyago may be trying to engineer a lower inflation environment more broadly speaking, so that he can reduce the inflation target, or at least entice the finance ministry to change the target to 3% from 4.5%. Should all of that unfold, they would require the rand to play ball and be a little bit stronger, because that would obviously help reduce inflationary pressures. So I think the Reserve Bank, in my opinion, is going to remain a little more conservative than some of the other central banks, and help try and lower inflation on a more sustained basis going forward.
George, I want to say thank you for all of that. Thank you for everybody that's listening, and we'll chat again. Enjoy your afternoon, George.
Thanks very much, everybody. Have a good afternoon.